As a dividend growth investor, earning as much cash flow on a consistent basis is very important to me. And what a lot of investors don't realize is that they're leaving a ton of money and opportunity on the table by not utilizing a covered call strategy and leveraging the shares they already own in their portfolio and earn more and more cash on a weekly, monthly, and yearly basis. Now in this video, we're going to go through exactly what a covered call is, and I'm going to go through and show you step by step on how to sell a covered call right here on the Robinhood brokerage. Now, if you're an investor looking to earn extra money off the shares you already have in your portfolio, make sure to stick around until the end of the video and like and subscribe for more content like this. So first of all, let's go over some of the basics. What is a call option? A call option is an option contract giving the owner the right but not the obligation to buy a specified amount of an underlying security at a specified price within a specified time frame. The specified price is known as the strike price, and the time frame is known as the expiration date. Now, when you buy a call option, you pay a fee to the seller, which is called the premium. When you sell a call option, you get paid the premium. Now, when it comes to selling covered calls, or if you're talking about options within the stock market in general, you're always going to be talking about 100 shares per lot. So it's very important to know that if you want to sell covered calls, you are going to need to own 100 shares of whatever stock or ETF you want to sell the covered call on. So simply put, one option will be 100 shares. Two options will be 200 shares, and so on and so forth. Now, right here on the Robinhood platform, you can type in any stock or any ETF and come right over here and say trade Apple options. Now, when you want to sell covered calls, you always want to go in the sell tab and of course the call tab. Then right here, this drop down, these are all the different expiration dates. And as of the film in this video, we have August 18th with a 4-day away expiration date. And again, this is how long it's going to be until this option contract expires between the buyer and the seller. There's going to be different expiration dates depending on what you're trading. For a stock like Apple, for example, there's going to be many different expiration dates, and they're going to span very, very far away. The furthest out expiration date for Apple currently is December 19th, 2025, which is 858 days away. Now, generally speaking, the further out the expiration date is, the more expensive the call option is going to be. And simply put, the further out the expiration date, the buyer of the call option is going to have to pay up and pay the seller of the call more and more money if they want the expiration date to be very, very far away. So now that you know what the buy and sell tabs are for the call options, and you understand the expiration dates, at least to a degree, this right here, what I'm scrolling through, is the option chain. Now, the option chain is going to have multiple different strike prices. And the strike price of an option is a fixed price at which the owner of the option can buy or sell the underlying security at. So when you're selling a covered call, you're going to want to have to come up with a strike price that you're comfortable with. Now, with covered calls, the further away the strike price is from the actual share price. With this right here, Apple's at 179.46 as of filming this video. The strike price of 180 is going to cost $1.35, or because we're talking in lots of 100, $135. The strike price of 182.50 is going to cost much, much less because it's much further up, and it's much less likely that Apple's going to achieve that within this given expiration date. So again, generally speaking, the further away the strike price is, north of the share price, the cheaper the option contract is going to be, because again, it has a less likelihood of actually reaching the strike price on or before the expiration date. So the next thing I'm going to explain is exactly how you earn money from selling covered calls and how it works. Going through a brand new stock just to show you how similar it is. If we were to sell a covered call in NVIDIA, let's say, you would go to NVIDIA again, go to trade options, go to sell, go to call, and then let's say that we want to choose an expiration date that's just around a month away, September 15th, which is 32 days away. Now, NVIDIA currently is trading at $439.50. That's the share price. Now, once again, to be able to sell a covered call of NVIDIA, you would have to own 100 shares in NVIDIA. And keep in mind, you can do this with pretty much any stock or any ETF that you currently own 100 shares of. It doesn't need to be Apple. It does not need to be NVIDIA. I'm just using these two as an example because they have lots and lots of different options within you. So now let's say you own 100 shares in NVIDIA. And let's just say as a side note that your average cost for NVIDIA for the 100 shares that you own is $440. So now if you were looking to sell a covered call and earn a boatload of premium, this is exactly what you would do. You've already picked your expiration date, which is around a month from now. So again, remember, with this contract, you're giving the buyer of the call option an option to basically rent out your shares and use your shares on or before this expiration date. But within the contract, you have to agree with the buyer on a set price. So let's say that I'm okay with getting rid of my NVIDIA shares for $450 per share. Keep in mind, we just said a second ago, we bought our NVIDIA shares for $440 per share. So if NVIDIA was to pass $450 on or before the expiration date, which is in 32 days. Then the option call buyer on the other side would have the right to buy your shares at $4.50 because that's the option contract you basically sign with them. So you might be saying, well, why would I want to do that? Why would I want to possibly get rid of my NVIDIA shares for $450 per share when I bought them at $440 per share? Even though in theory that'd be $10 of profit per share or $1,000 of profit overall. Maybe NVIDIA would even go up higher. Now there's a few reasons on why a call seller would want to do this. You would for one earn $27.83 per share of premium. This is the amount that the call buyer would pay you for basically, once again, renting out or using your shares in theory on or before the expiration date. So by selling the call option at a $450 strike price, you would earn $27.83 times 100, or $2,783 in premium. Now again, once you sell this call option, once you sign the contract with the buyer side, your shares now are sort of in limbo. Because in the meantime, if NVIDIA was to shoot up in share price, let's say it goes to $550, yes, sure, you earn the premium of $2,783, which is definitely great. But you definitely missed out on some upside potential because the call buyer once again agreed with you that you're willing to sell your shares to them for $450 at any time in theory on or before the expiration date. So let's say within the time frame, NVIDIA went up like crazy. Even though in theory, if the shares get called away, you are making the $10 of profit from the cost basis of $440 to $450. Plus you already earned $2,783 in premium, which the call seller gets paid instantly when the option contract gets filled. You still as a call seller could miss out on some upside potential. But let's talk about what would happen if NVIDIA traded sideways or maybe even traded down below the strike price on or before the expiration date. If you sold the same exact option to the call buyer and within the given time frame, the 32-day expiration date, let's say NVIDIA trades sideways, or let's say NVIDIA even for whatever reason trades down a little bit to $430 per share. Well, within the time frame, there's no reason for the call buyer to exercise the call and buy the shares at $450 per share, because let's say that NVIDIA was trading at $430 per share. In that case, the contract would expire worthless. You would of course still earn your premium because you get paid the premium right when the contract fills, and then you would still own your shares. You'd have no risk gearing your shares if NVIDIA trades sideways or even trades down within the given time frame. Now the crazy thing is like I said, you can do the same exact method of selling covered calls with pretty much any different single stock or any ETF across the market. Again, there's going to be certain circumstances where closed-end funds or other different investment vehicles don't allow you to sell covered calls or trade options, but for the most part, let's take GoPro for an example. GoPro is currently trading at $3.89 per share. So to get 100 shares of GoPro, you would need in theory around $390 or so. So if we were to sell a covered call on GoPro, let's say we bought 100 shares of GoPro at $4 per share. Let's say we want to pick a strike price of $5 per share for GoPro, which means in theory that if GoPro did move up in price and the shares got called away, you as the call seller would earn $1 per share from your share price cost basis to the strike price, which is $100 of profit. Plus you would earn 18 cents times 100 or $18 of premium. So if you bought GoPro at $4 and you sold a covered call at a $5 strike price for a 158-day expiration date of January 19, 2024, and if GoPro went up to $5.50 or $6 or $7 in between then, let's just say it rose up above the strike price by quite a bit. Well, at this point from selling the covered call, you would earn the $1 of profit per share, so $100 of profit, plus the 18 cents times 100. So by doing this trade, you would earn $118 in profit within 158 days. Now, once again, if you bought GoPro at $4 and GoPro went down to $3.50 or $2 in the time between now and the expiration date, well then of course you would still have your 100 shares of GoPro and you would earn the $18 of premium. The option would expire worthless at expiration date and you'd be back to pretty much square one. So now let's go over one of my actual examples of what I utilize as a dividend growth investor quite often in the market. So Realty Income is one of my favorite dividend growth stocks and I've been buying shares of Realty Income for years now. I currently own thousands of shares of Realty Income across my multiple portfolios. And even though Realty Income is paying around a 5% dividend yield to me, I earn a lot more than just that every single year by utilizing the strategy of selling covered calls. So what I do quite often is buy 100 shares of Realty Income when it's down in the red. So just as of recently, I bought 100 shares of Realty Income for around $58 per share. As I go to sell, I go to call, I pick the furthest out expiration date, which is January 17th, 2025, or 522 days from now. So next I pick the strike price. And remember, the strike price that's further away from the share price is going to become less and less expensive. So what I normally do is I sell a covered call one strike price away from the share price. So if you were to sell right now a covered call for Realty Income at a $60 strike price, which means, of course, again, that you're willing to sell your shares to the call buyer on or before the expiration date of January 17th, 2025. And again, you can pick whatever expiration date you want. But for me personally, I always pick a pretty far out one for this strategy. Now, for doing so, I'm earning a potential $2 per share profit if I bought Realty Income at $58 per share, and I'm willing to sell it for $60 per share. So the potential profit from that alone is $200 of profit. But don't forget about the premium. Because I'm the call option seller, I'm also earning around $435 of premium from the call buyer. So the instant amount of cash I receive from doing this is $435 because it's $4.35, of course, times 100 because options are always in lots of 100s. So the idea with this specific play is that I'm looking to hold on to Realty Income long term, and I'm looking to get paid out the monthly dividend consistently. Realty Income pays out a nice monthly dividend, again, around a 5% yield per year. But by supercharging this play with the $435 of extra cash infused, I'm earning around an 8 to 12% yield on my money every single year, with again some upside potential because again, the strike price is above where my share price is at. So there we have it, a quick beginner guide on selling covered calls and some of the basic information you're going to need to get started right away. If you enjoyed this type of video and you want to see more videos like this and want to see me go deeper and deeper into some of my really more advanced strategies when it comes to options trading in general, make sure to please comment yes down below and subscribe for more content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.